at the Hang Seng 50 on the daily chart. I'm always saying to guys that markets are fractal. So whatever price action we see on the daily can repeat itself on the monthly, on the weekly, on the 5 minutes. So if you're a price action trader, it really is up to you which particular chart or time frame you want to trade. The markets and the structures will repeat themselves. So what we have here is pretty interesting. Just a quick view of the long term. Then we just look at the most recent days, and you can see how that influences the way that you trade on the lower time frame chart. But if you just trade the daily chart, happiness, you will make just as good money as a price action trader. So what we have is Hang Seng 50. Let's have a look at a bit of a macro view. So the market sold off. This is way back 2021. Okay, so from 2021, the market sold off continually up to October of last year. And what are the distinctive things you can see on the charts? Yeah, we were selling off, but we were in a trading range here for quite a bit. And then dramatic sell-off, February to March last year. Went into a trading range and the sell-off continued. And of course, by now, you know how to put your measured moves in. Leg one, there is our leg one, pullback to the top of the pullback, and there is the extension, and the market got to that leg one, leg two extension. Another key one that you should look at is breaking out of a trading range. There is a distinct breakout from the trading range to the end of it, and we got to the measured move of it. So you would have left this in there, traded happily as a daily chart trader. Market gets down to here, and it creates what eventually became the low of 2022. You should be looking to take profits. Your measured moves would have assisted you. And of course, a lot of other opportunities would have just come your way. So we sold off to the end of 2022. And at the measured moves, the market created a reversal pattern. And one of the patterns that we're always looking out for is a wedge bottom. So 3 pushes, 1, 2, 3, overshoot in the zone of the measured moves. So you're expecting some form of a reversal. At this stage, you don't know it's going to do that, but you know at the measured moves, the bears would have been satisfied and the bulls want to come back into the market to take over the market because the bears have reached their objective. So you see that wedge bottom, you see the reversal pattern setting up. You don't jump in until the market starts to go up. You see a lower low double bottom. You see a bull close above the EMA. Now, what is distinct about this bull close above the EMA? Let me do this. These are some of the thought processes that go through your mind when you're trading, even on the 5-minute time frame. I mean, if you have a look, you could go back, just go back months. Okay, this is the first time we have such a strong close by the bulls above the EMA. Okay, and we are using the 10 EMA as an indicator of strength. I've since dropped using the 20 EMA because I want to be in the market when there is strong moves. So as long as the market is hugging the 10 EMA below it, I'm going to just keep selling. I mean, you could have just gone back, way back here, 6 months earlier, we had closes above the EMA. So this is the first time we had closed above the EMA. So if you're taking this trade, you can look to buy above this or buy above that, and your stop is down here. You can wait for greater certainty. Greater certainty means, hey, the market is going up, let me jump in there. But when you have greater certainty, you have less profits because your stop is still down here. You could tighten a little bit, but it's a wider stop, which is fine. Now, trading range price action, market went sideways. And if you're still waiting to get a little bit more confirmation, you've seen bulls breaking out. You have another bull breakout, but you have the trading range formed here, and we get to the measured move. But you have a bull breakout. And you say, okay, now I'm happy. Bulls have taken over the market. I've got to find a way to get into the market. The first pullback to the EMA, this inside candle, you could look to take that. And, you would not have been triggered on the next day. of that. But in case you said, okay, I'm just going to buy the close and you triggered your stop, of course, is at the nearest technical level, which I always harp on about. So you would not have been stopped out. If you're looking to hold for long profits, you got to be willing to allow the market to pull back against you. The market has pullbacks. You don't know how deep. So if you took that and the market is pulling back, if you've put your stop there, you're in trouble. If you put your stop there because you're afraid to get stopped out, you are going to get stopped out. So put in the appropriate stop level, which you'd have done there, been held, holding on to your trades. Market tries to break out beneath this little trading range. Not doing much more of an analysis of that, but you expect any breakout point to always be tested. Just keep that in mind as we move closer to where we are now. So the market comes back. I mean, if you look at this, the market closed here, huge gap down on that particular day, tested the breakout point, reversed, and became a bull candle. So if you didn't trade the reversal down there, that's fine, you wait for that. As a reversal trader, this is what I would have been looking for. Market gaps down, and I see that level would have been marked and remain on my chart. Failed breakout beneath it, reversal, I would have tried to get in as quickly as I can into that reversal, because the market is bullish. But if you didn't get in, it is not a problem. When you then see that candle, you can look to jump into that market, and your stop is here. Okay, on the daily chart, your stop is here. As soon as the market starts to accelerate and takes out a previous high, you can tighten your stop to here. So you've reduced the risk by half, and then you hold on to your trade. We have another breakout above a key level. So the market is broken out above that key level. We're going to expect at some stage a pullback to materialize and test that level. There was the first test of it. And all of these levels are opportunities to at the bears trying to test the breakout point. Okay, so remember I said every time you have a key breakout point, the market will come back and test that. We have another higher low here. Very difficult if you trade in the daily time frame. If you didn't take that trade with your stop down here, very difficult to jump in here because it's all overlapping candles, trading range behavior. But if you've determined that the market is going up and you just want to get in the market, you have to get in the market. Your stop has to be a wide stop. Your stop has to be here. Now, this is where the stop is. Now, that's a bear candle. George, of course, it's a bear candle. Low probability trade to jump in, but it is the first attempt to close beneath the moving average since we had this bull breakout. And the issue of using the 10 EMA, at least for me, or any moving average, the bulls have been buying constantly above the moving average. The first time the market comes back below the moving average, so it's a better price, better than the average price, they are, of course, going to buy that particular market. So you can expect the bulls to continue to buy. We have a low test candle. It's a bear candle, it's testing all of those lows. You can put your order above there or wait for a bull candle, put your order above there. The key thing is, where does your stop go? All of this trading range. So if you're taking that trade, your stop has to be down here. If you then taking a trade later on after we've had all of these highs and a pullback, you look to your left, find a low that is a technical level, so you can put your stop there if you trade in here. Then you wait to see what happens. Trading range price action, you got to hold on. Now, whether that is a 5-minute chart or a daily chart, you need just to hold on to your trade. Eventually, you have a strong enough bear breakout so you can pull your stop up to that level. I don't trade breakouts. I wait for pullbacks. So into the beginning of the year, big bull breakout, very strong for the bears. Then, for the bulls, you got to find a pullback. All of these are pullbacks, but nothing is triggered yet. If you triggered into your trade, your stop is here. Then you just have to hold until we have another bull breakout, which we get later, and you can tighten your stops. Now, where we are is interesting. Quickly, trading range price action. We go to the measured move, more trading range price action. Market created trading ranges, broke out, at the 50% extension, 200 extension, trading range price action. Another trading range, we got to the measured move, 50%, a little bit of sideways price action. So when you see all of this trading range price action, it is a pullback in a strong bull trend. The market is still going up. Our measured moves at this stage, if you look on the daily, we are in the zone of the pullback. The bulls want to get to the measured move. They've gotten to the measured moves every time the market created trading range. So we can expect that the bulls want to get to this level. Another measured move that you can look at, besides just the breakout. So this is from the low of the breakout candle to the half the breakout candle, is a leg one pullback, leg two. There's the first leg, there is a pullback, and there is the measured move that the bears are looking at. So this acceleration here was to test this level, which I'll look at very quickly for you, but also to get to the measured move areas. What you can expect is that if there's bull acceleration, there's a lot of resistance from the bears here, so we might go sideways. But as long as we remain above the 10 EMA, we are in a bullish market. So if you are long on the daily, this is where your stop has to be, and you just have to hold, and hopefully you'll get acceleration up. If you're looking to buy into the bull trend, you need to wait to get a bull candle today or the next day and buy above it, but your stop is there. This key level that we are, this is an absolutely key level. So I've marked it as the lower high double top for April and June 2022. Let's have a look at it so that you can keep that in mind. Okay, so that's that level. After the bear breakout that we had, the market came back and tested that level, created a lower high, then with another lower high double top and another double top here. So that is an absolute key level that the whole market is watching. Coming down here from when we had the bear breakout, we had a double top, a double bottom here, and then we broke out beneath it. So again, in the same level that we had, we've been oscillating around it. So that is a key level that we expect the bears to defend. The bulls, if they are strong, they want to get above that and get to that high of 2022. If a trading range is created here, you can guess what the bulls are looking at. What the bulls want is this measured move. That's the earliest goal, just of that pullback, and if we go out, break out of that trading range. And if they get above that, then they look for higher measured moves. We come back to here. But their goal, and you can just think about it, if you're a bull, your goal is to get to that level. So opportunities for us to keep trading. If you're trading on the daily, you gotta be just waiting for your bull setups. There's no reversal until we have a reversal. And just the fact that the price is high in the 10 EMA indicates for us that there is still huge bullish momentum in the market. This is George, Craftsman Trader. I trust you enjoyed this 15-minute blitz through the market, and we will catch up again with everyone next week. Let me just check. No question, but thank you very much. We will catch up in Wednesdays at the market next week. Thank you, guys. If you are on the mentorship pathway, I'm having the course on Saturday. Make sure you are in that course, Trading the Open. You absolutely love it. Take care, guys. We will see you again next week. Bye-bye. Marlon, thank you, boss. Bye-bye. Thanks, Gary. Hey, cheers, guys. See you then. Bye-bye.